Telstra gives its 1 million plus shareholders good news on dividends. The unemployment rate jumps to 3.7%, and Mattel hopes Barney the purple dinosaur can turn around its fortunes. It's Friday, the 17th of February, 2023. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
I never thought I'd be starting a show with Barney the purple dinosaur, Sean, but there you go. And you know what? We go from Barney the purple dinosaur to Austrade chief economist Heather Cotching, your guest today in the Fear and Greed daily interview.
Where's the link?
There is no link. That's what I'm just trying to say, that we cover the extremes here, Sean, and I've managed to transition from one to the other without
Nicely done.
any grace whatsoever.
Good. Yes, we have a great chat to Heather about what happened to Australian exporters, particularly in the middle of the pandemic, just how good Australian exporters are at running businesses, not just exporting stuff, but actually running their own businesses. In fact, they outperformed non-exporters, and we go through, it's such a wide range of Australian companies that export. We go through that. It's just a fascinating chat about a really important part of the Australian economy.
Yeah, it's a really interesting conversation. It's coming up a little bit later on. But the main story this morning, Sean, Telstra gave a shout out to investors yesterday saying, don't forget us. The country's largest company in terms of shareholder numbers beat market expectations, triggering a 2% jump in its share price to $4.22.
Yes, we don't talk a lot about Telstra, but we've got to remember there are more shareholders of Telstra than any other company in the country. In terms of numbers yesterday, total income jumped 6% in the December half. Pre-tax earnings rose 11%. Net profit was up 27%. They are good numbers by anyone's standards. The increase in dividend to 8.5 cents a share will certainly please that 1.3 million shareholder base that Telstra has. Now, the driver of the business nowadays is mobile. It makes up more than 50% of profits. In fact, pre-tax profits was about 57% in the final 6 months of last year. It really is the powerhouse of the company nowadays. There was also a benefit from the return of international roaming charges. Now, COVID lockdowns have been lifted, and Telstra's been able to push through price increases to offset inflation, and new contracts, in fact, include provision for price hikes once a year. Crucially, Telstra didn't just increase its prices, but what it can do now is go to customers once a year, probably in July, and say, we're reviewing and we can up prices for those 12-month contracts that you sign up to. Telstra also benefited from Optus's cyber attack. It picked up around somewhere between 10 and 15,000 customers as a result of that. So a pretty good half year.
Yeah, absolutely. And Vicky Brady took over from former CEO Andy Penn, I think in September of last year. So this is a very good result for the new boss. What's next for the telco?
Well, the 5G network is critical to Telstra's future. It is the dominant player in that space. And loyalty seems pretty strong at the company. That's good news for Telstra. Churn rates are relatively low. I mean, things like the Optus attack certainly helps those numbers. Also, we now live on our mobiles, so changing providers isn't quite what it used to be. Customers tend to be much stickier, and that's a good thing for Telstra because it has such a dominant position in that market, in the mobile market. Where there is some angst is around the prices the National Broadband Network charges telcos. Now, Brady said yesterday Telstra will have no option but to push up prices that it charges its customers if the NBN goes ahead with proposed price changes. Of course, Telstra isn't particularly competitive when it comes to the NBN. So it's pushing that 5G space rather than the NBN space. But all in all, Michael, pretty good result for Telstra and its shareholders.
Yeah, certainly was. I do have a concern about the use of the term sticky in relation to customers. It just seems vaguely kind of icky. Can I exercise my veto? Do I have any kind of veto rights to words that you use on this podcast?
Well, Mickey, I don't think that sticky is icky, so no.
Okay, all right. Overruled. Officially overruled. Thanks, Sean. Good to know. Good to know we're a team here.
It is funny, Michael, but sticky is a word that economists use regularly. So sticky prices, things like that. I know I have never been offended by the word. Now you've brought it up, I'm sort of heading your way a little bit, so maybe we will ban it.
I reckon, hopefully, my goal is now that I have ruined that word for you permanently. So now whenever you hear it used, even by economists like, say, Stephen Koukoulas on the week ahead, that you will now get this little involuntary shudder go through.
Maybe. Thanks for that.
All right, anytime. How did the ASX go yesterday?
Well, the ASX 200 finished up 0.8% to 7,410 points. It's kind of a crazy day, really. Like Commonwealth Bank lost 1.3%, but Macquarie Group jumped 3% and ANZ rose 0.6%. The iron ore miners did pretty well. FMG rose 1.2%, but CSL was down more than 2%. Transurban, Woolies, Coles and Aristocrat Leisure all did pretty well. Wes did very well the day after its results, jumping 4.2%. As we've said a few times over the past week, it's just interesting watching the price action of the companies who have announced their results, not just immediately after that announcement, but in the 1, 2, 3 days afterwards. And that's kind of what we're seeing at the moment.
And what about international markets? What's going on?
Well, there was big news yesterday morning. Strong retail sales in the US boosted expectations of more rate rises in the world's biggest economy. I suppose we already knew rates were going to rise, but it just confirmed that. And people are wondering whether they need to go further. That pushed the US dollar higher and the Aussie dollar lower, back towards 69 US cents. US retail sales jumped 3% last month, and that's the largest increase in nearly 2 years and well above expectations. Of course, that came after US consumer price index figures showed a big jump in January as well, suggesting inflation was, not stickier. Oh, I said it. Sorry.
Oh, the temptation. I could feel you were building to something. I'm like, oh, here we go.
Yes, just the inflation sort of hanging around. How about that?
Yeah, I've ruined it, haven't I?
You have. Otherwise, not a lot happening in oil, coal or gold markets. Cryptos have done pretty well over the past 36 hours or so, though.
All right. We'll be back in a moment with the rest of the day's business news. Sean, the unemployment rate crept up to 3.7% last month, while the economy has now laid off workers for 2 months running.
Yes, it suggests that maybe the 9 successive interest rate hikes are starting to bite. Mind you, Michael, an unemployment rate of 3.7% is still very, very low by historical standards. The Bureau of Statistics figures yesterday showed that 11,500 people lost work in January, a result below economists' expectations. There was a near 32,000 increase in part-time employment, but that was more than offset by a 43,000 drop in full-time employment. The number of unemployed people increased by almost 22,000, while the underemployment rate held steady at 6.1%, which remains pretty low. The participation rate edged lower to 66.5%, but that too remains near record high levels. In its latest statement on monetary policy released last Friday, the Reserve Bank said it expected the unemployment rate to increase over the course of the year. In fact, reckons it'll hit about 4.3% by the end of next year. This rise in January was probably more than expected. Bit of a note of caution on this. January is a bit of a weird month. People come in and out of the workforce more than other months. And so some economists say, look, don't read too much into just 1 month. Wait to see the trend.
Sean, I rarely read too much into anything, so consider that one done. Now, Newcrest, this is a big development, perhaps, has rejected the $24.4 billion bid from global giant Newmont, but has left the door open for a return offer.
Yes, when I was writing this story, I thought it's a Clayton's rejection. But then even for someone of my age, a Clayton's rejection isn't an obvious reference. Do you know what it is?
Well, I know I am familiar with Clayton's. That's the drink, isn't it?
The drink you have when you're not having a drink. That was their tagline, I suppose, in the 70s or 80s. It was and they had Jack Thompson used to be on the ad. Jack Thompson was a superstar.
I only know it because I've heard my parents reference it before. So I don't think I'm supporting your campaign to sound younger than you are.
Righto. Well, look, Newcrest sort of rejected it, but didn't really reject the Newmont offer. Newcrest will give access to Newmont confidential information in the hope that it flushes out a higher offer. It came as Newcrest outlined its half-year results. It announced a better-than-expected $428 million profit and a much, much bigger dividend for shareholders. In fact, if you include the interim dividend, the special dividend, it was about 3 times higher than what analysts expected. That's always good to be doing that when you're under a takeover offer. Acting Chief Executive Sherry Du said the higher than expected dividends reflected the company's confidence in its ability to simultaneously develop projects and maintain shareholder returns. In recent years, shareholders have pretty much complained about Newcrest's payout ratio. Frugal is probably a good way of describing it. Not yesterday. On the Newmont bid, big shareholders have said it's too low, and obviously the Newcrest board agrees. Yesterday, Newcrest said Newmont would be allowed to access some non-public information. What's all that mean? Wants a higher bid, basically.
All right. Now, National Australia Bank says rising rates have been good for business but bad for customers and the economy as it joined Commonwealth Bank in reporting record profits driven by the higher rates.
Yes, golden period for the banks. National Australia Bank said it made $2.15 billion for the last quarter, just 3 months, up 18% compared to the average of the previous 2 quarters, well above expectations. NAB's Chief Executive Ross McEwen said net interest margins have risen. He conceded that economic growth and house prices were softening while loan repayments keep going up. NAB hasn't seen a big jump in distressed borrowers, which is good news. Its share price rose 0.6% yesterday.
And just quickly staying with the banks, Sean, Westpac has joined Commonwealth Bank in pausing regional branch closures while a parliamentary committee examines how exits are impacting communities.
The challenging issue of branch closures was referred to the Rural and Regional Affairs and Transport References Committee last week for an inquiry.
Well, that's a catchy name, isn't it?
It
rolls off the tongue.
Quite the acronym too, RATRUC.
Sorry, what is the acronym?
RATRUC.
I love how you roll the double R at the start. Please continue with whatever credibility you have left.
Well, RATRUC is supposed to put out its report by the end of this year, but it's really put the banks under pressure to not do more regional branch closures. Westpac yesterday said 8 proposed closures are now on hold. Commonwealth Bank also put on hold proposed closures. They announced it on Monday this week. Now, Westpac will continue its announced branch co-location program. It's basically combining brands like Westpac, St George, Bank of Melbourne and Bank SA all under one roof. But the bank's feeling the political pressure.
Sean, here's a little bit of good news. One-time blue chip AMP has returned to profit and given long-suffering shareholders a dividend for the first time in 4 years.
That's the good news. There is bad news, though, and that's its core wealth management business continues to suffer outflows. Now, that triggered a fall in AMP share price yesterday. It was down as much as 14%. It finished just a little bit better than that, but not much. Aside from a special dividend of 10 cents a share in late 2020, the board hasn't declared a dividend since early 2019. Now, that was just after the Royal Commission levelled allegations of criminal misconduct against AMP. Yesterday's result was helped by proceeds from the sale of the infrastructure debt business. AMP is another one of those companies with huge amounts of mum and dad investors, and so the dividend really matters. The fact that it hasn't been paying dividends has long aggravated retail shareholders. You know, the company's 173 years old. For the past 3, 4, 5 years have certainly been its worst. Think of the post-Hayne malaise, the leadership changes, the fallout from its mishandling of sexual harassment allegations. Shareholders have suffered a lot, but yesterday they at least got their dividend back.
Sean, there's a growing scandal involving big accounting and audit firm PwC, with between 20 and 30 PwC partners and staff involved in sharing confidential government tax policy information.
Yes, quite a story that's been bubbling along. The information was obtained by former PwC partner Peter Collins. Now, tax practitioner board boss Michael O'Neill told Senate estimates on Wednesday night that 20 to 30 PwC partners had shared that confidential information, according to a report in the Financial Review. O'Neill said that PwC partners and staff, both in Australia and internationally, were involved in monetising the information passed to them by Mr. Collins, who had signed confidentiality agreements between 2013 and 2018 while consulting with Treasury and the Board of Taxation in designing anti-avoidance tax laws. A big no-no here. The tax office first discovered the leak of government documents during a company audit. The revelation that the leaked data was shared with up to 30 people at PwC comes as the Big Four firm seeks to draw a line under the affair. Now, Mr. Collins resigned late last year. In December, he was deregistered by the board for 2 years.
Sean, the country's largest property group, industrial giant Goodman, has upgraded its profit outlook for the 8th straight year as demand for warehouses around the world soars.
Yes, operating profit jumped 12%, though the statutory profit, which includes property revaluations, actually fell. Boss Greg Goodman said the company's strategy to focus on high-quality properties in high barrier-to-entry infill locations is working. What that means is it's really hard to find industrial property land, and Goodman has plenty of it. Occupancy remains at 99%. Pretty incredible, and rents are rising. Goodman said on average, new leases were subject to higher annual reviews than the existing leases. He reckons there are opportunities in the US, Australia, New Zealand, Europe, and the UK. Not surprisingly, the company's share price finished up 2% to $20.23 yesterday.
How about this one? Consumers, Sean, are opting for slim and sleek cans in alcoholic seltzers, pre-mixed spirits and craft beers. They're lighter and more convenient for millennials and Gen Z, and that's helped can and bottle maker Aurora.
You guys must love this stuff. You know, the 250ml bottle, light, convenient, drink your kombucha.
No, okay. You are just playing to a stereotype now, Sean. It doesn't fly. I do enjoy craft beer in cans because it's easier to recycle the cans. You can fit more of them in your
nicely
in your
said.
bin.
You're working the stereotype pretty well yourself, just quietly.
Yeah, but when it works for me, please go on.
Anyway, Aurora's share price jumped 15% yesterday, the best of the top 200, after its half-year earnings showed that volumes had increased by more than 10% in the 6 months to the end of December. Now, the company's investing heavily in plant expansions to keep up with demand. All about the 250ml cans in soft drinks and kombucha segments, apparently, Michael. In fact, the company now has more than 200 customers in the seltzer and craft beer segments. It's about twice the level of 3 years ago. Oh, my word. What's happening to the world? Anyway, overall, Aurora said net profit was up 8%. The group was upbeat about the current 6 months, hence the share price surge.
Finally, Sean, ASX, the company, reported yesterday and pretty much did a mea culpa on its disastrous technology project, which pretty much is a lesson in how not to do an IT project, which is pretty damning, isn't it?
It is. I mean, ASX had to write down $176 million on the back of the chess replacement project that didn't happen. Well, not yet anyway. Chief Executive Helen Lofthouse, who wasn't running the ASX at the time, said the company needs to listen to the market on the new platform design. In fact, the ASX will pay market participants for assisting in the new design. Something needs to be done because the existing chess platform runs on a more than 40-year-old computer language called COBOL, which some of us actually remember. Overall, ASX earnings were flat, even taking the write-downs into consideration. That's not a bad result, given it had to write off $176 million. The company's share price finished up a touch.
All right, let's turn to international news quickly now, Sean. And New Zealand said it is open to offers of international assistance as it battles with the aftermath of Cyclone Gabrielle, which caused widespread flooding and landslides in the country's north and cut off some towns.
5 people have been confirmed dead after 4 days of strong winds and torrential rain. Authorities say 100 people are missing. 10,500 have been displaced. Prime Minister Chris Hipkins yesterday warned New Zealanders that the recovery will take time, with power not expected to be restored to some areas for weeks, and the cleanup likely to take much longer. The New Zealand Defence Force has deployed 2 large ships and a C-130 Hercules transport plane to deliver thousands of litres of water, along with personnel and several mobile water treatment plants, to the most hard-hit regions.
And finally, Sean, I mentioned this one at the top of the show, clumsily, of course. Mattel is hoping a relaunch of Barney the purple dinosaur on TV screens, in theatres, and the toy aisles can revive the struggling group.
Yeah, so Barney's about 30 years old, believe it or not. And Mattel's hoping that he can resonate with today's parents and kids. So an animated series for preschool kids is set to debut globally next year, according to the toy maker. Plans include books, apparel and accessories, as well as toys and content for YouTube. Now, Mattel's also making a new Barbie movie starring Margot Robbie, the great Australian actress. It's slated for release this year. Basically, Mattel and Hasbro Inc., which is the other big international toy maker, have really struggled in recent years and they registered lower than expected year-end results. Basically, Mattel is hoping Barney can save their hide.
All right, there we go. Up next is the Fear and Greed Daily interview with Chief Economist at Austrade, Heather Koching.
Yes, all about how well Australian exporters did during COVID. And kind of we go beneath the surface a bit, beneath the numbers, and talk about the areas that they export from and where they export to, and just how good they are at running a business.
Yeah, it's a great chat. It's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Before we go, Sean, a very quick shout out. We've been contacted by a listener, Meg, about another listener, and she's written to us via LinkedIn. She says, my son Jack is in year 12 studying economics. His teacher recommended he listen to Fear and Greed and he listens to it on his way to school each morning. How awesome is that? I agree, Meg. I think that is awesome.
Yeah, absolutely. Good luck at the HSC, Jack. And shout out to Jack's teacher as well, for telling his kids to listen to us.
Jack, if you made it all the way to the end of this episode today, thanks for sticking with us.
Absolutely. And Meg too.
Thank you very much, Sean.
Thanks, Michael.
It's Friday, the 17th of February, 2023. Make sure you're following the podcast and join us online on LinkedIn, Instagram, Twitter, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.